Hey guys, Dan Murphy here, and today is part 2 of the ETF trading boot camp. And in this one, I'm going to go over day trading ETFs. This is my specialty, and this is where a lot of the big bucks are at right now, especially with the advent of all these inverse and leveraged ETFs. And that gets me to my next point: is you really need to see or review part 1, and I go over the basics of what ETFs are. They basically trade like stocks, and also just some serious problems with holding these ETFs longer than a few days. There's a few people that emailed and saying, hey, my ETF doesn't seem to do what the one you're talking about does. Well, it's because when you finally enter a period of time where these ETFs are extremely volatile, and especially when they're leveraged, everything gets out of whack. There's an entire lawsuit against pro funds against this. Look it up on the internet. It's all over the place. It's real, folks. Do not miss out on part 1. I'll say it again. This was not some kind of accident, not an urban myth. It is real. Okay. I don't want to scare everybody off, but let's get into the real deal, the meat of part 2, which is day trading ETFs. And I'm going to have to start off. I hope I don't sound like too lectury when talking about this, but here's what a good day trader should be. So why don't I just label that? Let's see. A good day trader has money. So has money, and specifically according to US law, the minimum to day trade with for the pattern day trader rule is $25,000. My good old Uncle Clarence always said, if you do a little, you get a little. If you do a lot, you get a lot. And my take on minimums is that you don't want to do the minimum. You want to do what is right and what is going to make money. I always talk about 95% of traders lose money. With day trading, it's more like 99%. And I did not get this number out of a hat. This is actually a testimony before Congress. I can't remember exactly what it was relating to, if it was right after 9/11, but basically the CEO of a major brokerage was saying that just most everyone is just losing their shirt, and that's why they had so much political gumption to go ahead and say, hey, let's go ahead and regulate some more. And I don't care what all these traders are saying. We're going to do it for their own good. I really don't like it when the government steps in like that. But they did have a lot of power because of the fact that so many people just lose their shirt. And honestly, more people spend time looking at what kind of TV they're going to buy than how to make money day trading. They just assume you can follow the news and somehow make money. It couldn't be anything further from the truth. Now, I want to start off with probably what I think is a minimum and a decent starting point. And you've already made money doing whatever it is that you do. You're a professional at something, and you've done it well, and you've saved up at least $35,000. And this number is not random. The reason I have it like this is because most people start off trading and following some system that's already done really well, so it's been going up a lot, and then all of a sudden you jump in here as a new trader because you get excited, and then that system sucks for a while, and you experience what's called a drawdown. And then hopefully the system goes up like it should. The majority of traders, this is what happens. I see it time and time again in this business. I've been doing this since 1998, and usually people follow my best performance and then get really excited, and then that's when the performance starts going down, and then usually that's when people start jumping off, and that's where the market takes off again, where that special trading method will go ahead and start working again. Seen it time and time again. Most people are going to experience at least a 20% drawdown right from the beginning, and that's where I came up with this number. Now, the minimum again for trading, what the government says you can do in the United States, you need to have $25,000 minimum all times in a margin account. And if you don't, Well, if you make 4 trades, so I'm going to write this down. So pattern day trader, you're going to get flagged as a pattern day trader if you make 4 or more day trades in 5 trading days. If you do this, they're going to suspend your account for 90 days. Okay, but honestly, a lot of brokers nowadays, what they'll go ahead and do, if you have less than that $25,000 minimum, then they'll just tell you that you can't open any more positions. You can only close positions, because they don't want you doing that. So, even with swing trading, you can get stuck with this pattern day trader rule, because you might get stopped out right away. You never know. Now, again, the minimums, I don't really like minimums. The number one reason that small businesses fail is undercapitalization, and I could say the exact same thing about trading. So if you have a couple grand that you've saved up, this is not for you. Just go ahead and you can just skip this video, or knowledge is power. You can just keep on watching it as well. But I'm really going to talk to people that have already had success and were able to save money, and a minimum of $35,000. And without further ado, let me go ahead and get into some more day trading and how to make money day trading. But first, I need to talk about margin. Good old margin. In the days before these leverage ETFs, we basically you could go a maximum of 4 times leverage. And what that means is you put in $1 and you could actually buy $4 worth of stock. And you could also say this is that would be 25% margin. What's cool is nowadays we don't really even have to worry about this stuff anymore for day trading, about that 4 times leverage. And the reason why is I'm going to switch charts here real quick. Let's see. Let's go ahead and put up, let's see, FAZ here. This is one of my favorite day trading instruments. It's got lots of edges in it. Well, if you look at the top blue bar across the screen, FAZ, it's a 78-minute bar chart, so it divides a day into 5 different sections, but it's a 3 times bear fund. So right from the get-go, you're trading at 3 times margin. So you don't need all that 4 times margin. You don't have to do all that stuff anymore. It's all simple. And I know for those of you that are crazy, and I definitely mean crazy, you could think of, well, if these things are already leveraged at 3 times, can't I go ahead and do 3 times leverage and then the 4 times leverage that I'm allowed with day trading? The answer is no. That loophole is now closed by the SEC. Let's just keep things simple, and we're going to just go ahead and buy with cash with these ETFs. I think that's just really the best way to do it. And let's say that I had a real simple example. I have $50,000. I might divide that into 2 different stocks. Or sorry, I keep on saying it, 2 stocks. ETFs. So I might invest $25,000 for a day trade in one. And then when there's another trade to make, I might make a $25,000 trade in that one as well. Okay, so the maximum I would have would be, say, 2 open positions, and then each one could be a maximum of $25,000. Keeping it real simple. We don't have to worry about all the margin stuff anymore because we're trading intraday. Let's just worry about having enough capital and the focus on what exactly makes money trading. So without further ado, that's what I'm going to talk about right now, is the how. How the heck do you day trade and make money? Because again, 99% day traders fail. Well, okay, the main reason why is, okay, look at what everyone else is doing. Go to a message board and read what people are talking about if you want to learn how to lose money. Most people are going to be drawing trend lines. They're going to just be using some crazy technical analysis. there's a ton of different ways to pull money out of the market, folks. What's in popular domain usually doesn't make you money. I mean, you might be the most gifted Elliott wave trader or something. That stuff is really, really tough. What I want to do is I want to make consistent, if I'm spelling that right, spelling is not my forte. I want to make consistent base hits. I'm not looking for home runs. I just want to hit base hit after base hit after base hit. I don't care if it's a single or a double or a bunt or a walk. Just get me on base. That's all I'm really asking for. And the way that I found to do that is finding a statistical edge. So that means that I have to test with a computer. So I have to know my stuff, and therefore I have to have a proper trading platform. So this is TradeStation. Okay, I recommend TradeStation. It's really easy to convert what you're thinking in your head to some really simple, they call it easy language, and I'll show you that in a minute. This is how I make money. This is what I've seen make money time after time after time. In fact, it's mechanical trading systems have outperformed other CTAs by factor. I believe it was 3 or 4 to 1 versus discretionary traders. I'd have to get back to you on the exact number of that, but you could probably Google it and see what I'm talking about. Now, at first, it might seem like a really tough task if you're not computer savvy and programmer savvy, especially. Well, if you don't learn it, you're not going to do it. You're not going to make money. If you want to do the very minimum, then you're going to get the minimum result out of that. Trading is serious hard work. You have some extremely smart and capable money managers out there that are finding edge after edge in this market. And to think that you can pick up a book and learn about trading and somehow make money against these professionals, considering the uphill battle that 99% of day traders lose money, I mean, come on, man. We got to be realistic here. This is a game of professionals, especially in the day trading realm. This has been the hardest thing that I've ever done before. I have lots of swing trading systems. I can just show you. Here's a quick example of a system that just kills it. This is for swing trading, huge profit factor, and the big thing I want to show is it's almost 80% winners, and this tremendous equity curve since back in the mid 90s. I can find a lot of edges in swing trading, and I'm going to have to admit that it's a lot harder to find edges in day trading, and that's because everyone wants to day trade, and that's where you're going to see a lot of people when they find an edge, they're just going to be gone eventually and wiped out of existence. But there's certain things that I've found time and time again make money in the market with these statistics, and that's anomalies. Not even sure if I'm spelling that right. Is anomalies? Jeez. Okay. What the heck is an anomaly? Well, it's just something out of the ordinary, something that just doesn't make sense. And I'll show you that right now, and this is actually the basis of a trading system, of a pretty basic trading system, but I think that you might be able to get the gist of it. So here we have a chart of DGP, he tried to say, 78-minute bar chart, so this divides the day into 5 equal sections. And this is the double gold long ETN. I don't trade ETNs. That's why I want to show you this one just as an example. It's not something that I will ever trade, so I'm not too worried about it getting out in public domain. So what I want to do is look for an anomaly. And again, this is not something that you can use your basic charting package, free charting package or something like that. This is day trading. This is really hard work. You have to spend a little bit of money to make a lot of money. This is professionals' realm. Okay, I can't emphasize that enough. So I don't want to scare you off, but I want to be really realistic with you with trading. Okay, here's these little dots on the screen, and those dots basically correspond to an anomaly. And so here we go. If you look at this little drop down box on DGP, you'll see where it says up volume, it's about 9,100 shares, and then down volume, 11,700 shares. Now, so what does that mean? So up volume is the number of shares that were bought at the asking price. So that's basically, above the market. The ask is above the market, bids below the market, and usually trades take place in between or at one of those prices. So what you would normally expect when you see this bar going up is that the majority of the volume should have been at the ask, should have been pushing that particular ETF upward, and it's not. You actually see more at the bid. Well, that's an anomaly, and anomalies make you money, folks. Just the same as it's an anomaly to actually make money in the market. So I suppose they go hand in hand. Well, I told you I was going to give you a real basic trading system, and this is not something that I'm trading, but a picture's worth 1,000 words, so let's just go ahead and just see what that equity curve looks like. Again, just real simple, steady upward equity curve. It goes long and short with exactly the opposite rules, and profit factor of about 2, win percentage of nearly 56%, most of that coming on the short side at 60%. But again, the exact same rules and opposite tend to work, long and short, and that's what I like to see. I like to see a market where these inverse rules work together. Okay, so what the heck is going on here? Let's go ahead and look for an anomaly when the market is up. So let me show you on this bar over here. It's up over a 78-minute period, but it just so happens that its counterpart, which is just the regular GLD, there's actually more up volume in this particular bar than down volume, and that's what you would expect. If the bar goes up, usually there's more up volume. And a lot of chart packages, not just TradeStation, will show you this, but I think TradeStation is probably the easiest to use, and it's extremely quick to basically go from idea to execution, and I think that's very important in the ever-changing world of day trading. Okay, so you have what's normal, which is more upticks than downticks, and GLD is up, but then you have DGP rather. I keep on thinking of some economic statistics, I suppose, since that was the big news du jour the other week. Not that I trade on news. Well, you have that anomaly where this market went up with very little up volume compared to down volume. There is an anomaly there. The close is greater than the previous close over here, and it's not too big of an up bar. So in gold, especially when you have a big up bar, it usually continues that direction. But if it's just a normal, everyday, run-of-the-mill up bar, and you have this anomaly, short it. The market's probably going to go in the opposite direction. And speaking of opposites, the opposite rules apply. So let me go ahead and show you an example of that. Let's scroll back a little bit here. And okay, so this is for going long, for buying the market. So we have right here a down bar, and the open minus the close wasn't too humongous. There's a big gap, but in that particular 78 minutes of trading, it wasn't too huge, because keep in mind that there's two different markets. You have mean reverting, those that tend to go down and then up, or up and then down, like the S&P 500, or gold. If it gets going, it really gets going, and it's trend following mode. And so if you have a big bar right here, if the close is way underneath the open, it might continue going in that direction, and it does quite often. Okay, so the opposite rules. Now remember, look at the down volume versus up volume. So we have an anomaly there. The up volume was more than down volume, but the bar was actually down, so that's kind of weird. But in gold, it was just business as usual. We had 2.8 million shares on down volume, and then 2.7 million up volume. So volume traded at the ask was lower than that traded at the bid. Typical behavior. So it seems that DGP, there's actually smarter money there. It looks for a reversal, and these guys somehow are the smart money versus just the everyday trader in GLD. And it's kind of surprising. You would think that DGP traders might be like option traders and usually wrong way, but that does not appear to be the case. And in fact, all the time I find that when I believe something to be a truth or a market axiom, I'm completely wrong when I test it. And that's why I test, and that's why I suggest you do the same if you want to really beat the market. And what I'll do real quick is I'm just going to drag this little piece of code over so you can see that it's not anything crazy. This is for shorting, this section right here. That's the rules I just explained to you. And then it also adds a stop and some money management that I didn't really get into. Didn't want to make it too complex. And then the reverse rules are right here. It's only a few lines of code, but the basic idea that I always want to teach you from the top down is to look for an anomaly. And I'm going to spell it correctly this time. Just want to hit this home as much as possible. Well, I guess I did spell it right the last time. Okay, got to give myself more credit. Alright, so anomaly. That is something you need to look for. Lots more than just that. There's intermarket relationships. I'll write that down. So intermarket relationships. They're attack of the spelling. Okay. There. Let me X that out completely. Just when I think I can spell, it comes back. Okay. Relationships. Okay, so it's intermarket relationships. And by that I mean, say, let's say the stocks or the indices themselves, let's say like the S&P 500 versus bonds. There's a good one. Or a more recent one, gold versus the dollar. Now these relationships don't always last. This one's been pretty tried and true, but back in the late 90s, bonds and stocks rose together, and I just want to point out that those relationships don't always last. So anomalies mixed with all these different relationships, and it could be volume, price, what have you. That's going to make you money. It's the anomalies, the weird things. If you see the market doing something weird it probably shouldn't be doing, study it, test it. Perhaps it might make you money. I would say that one out of every couple trading systems actually makes me money. But every time I've programmed my ideas into a computer, I've learned a lot about the market, and that's all you can really expect, is to work hard and you will actually get something in return. You work at the minimum, you're going to get the minimum. Okay, so well, now that I've showed you the basic overall strategy to use to make money in the market, let me just go ahead and show you what some full-blown systems look like for beating the market, and the statistics that go by it. And you know, earlier I used FAZ. That's one of my favorites for day trading these ETFs, and that is the financial market. And usually I trade these in pairs, so FAZ and FAS. Okay, so let's go ahead and just I'll show you the equity curve and statistics for trading FAZ. Okay, so lots and lots more trades, and this is for the past couple years here, almost 2 years. And statistically, again, we're the profit factor hovering around 2, and that's with commission and slippage. Lots of trades, about 315, and again, the win percentage is not going to be crazy. It's going to be the average win versus the average loss. That's the big determining factor that this system actually makes money. Okay, and if you want to see some more examples, let's go ahead and do. Here is a small cap index. So using pretty much the same rules, I call this the VP trading method. We have bonds, a little fewer trades there since it trades unidirectionally and doesn't trade on the long side. It just trades short on TBT. Yeah, well, here's one of my favorites of all time. This is the NASDAQ 100. And again, this is using the very simple VP Trader rules. This goes back to 2006. That's why I can say that it's not some fluke that these rules have been working, let's say, since 2008. I've got lots and lots of trades going back to 2006 using those simple rules. And this is a little bit different from what I showed you with that anomaly, with that volume stuff. This is a little bit more sophisticated intermarket relationships and not really looking at that same thing with the volume that I've shown you before. Again, I call this the VP trading method. Here's on the Dow. Here's some large caps. And again, back to the original system that I was showing you, which was the DGP, the double gold fund, ETN fund, which I do not trade, by the way. But let me just go ahead and recap what we've learned so far. And this video is a lot longer than I wanted it to be, but there's just a lot of information to be covered there, and I still have a lot more to cover, and that'll be in the next one. But the bottom line was that don't do minimums. If you do, the government says you need at least $25,000 to day trade. And if you want to make money day trading, basically what you need to do is have some kind of a statistical edge. So something that will give you base hits over and over and over, and it has to be proven. So basically you're going to need to use a computer to do that. You don't want to test this stuff by hand. It's much too complex, too much data to crunch through. And what really becomes the glue and gives you that edge that you look for on the computer is some kind of an anomaly. Hopefully that's coming out in this yellow on white. I'm sorry if that's tough to read there. I like it when you have the same set of rules. So I'll just abbreviate that. Set of rules works on basically lots of different symbols or tickers, markets. It's going to be hard to see. So the same basic strategy, that same anomaly that you found, if you find that anomaly in, let's say, the small cap stocks, bonds, NASDAQ 100, large cap stocks, real estate, financial markets, gold, silver, oil, if all that stuff tends to work, the Dow, and it works really well using the basic same strategies, same set of rules, same anomaly, you have a really kick-butt trading strategy. But in the meantime, I hope that you've learned a lot today. I know it was a lot of information to soak up. Until next time, it's Dan Murphy signing out.